What's going on, everybody? Welcome back to the channel. Welcome back to another video here. Got a special guest on here, Michael Burns. He's a lender that I work with, really good friend of mine as well. And we're going to be jumping into this, talking a little bit about interest rates, talking about the market, where it's going, what's happening, and just overall what we're expecting to see in 2022. I wanted to jump in here and do this because as we go into spring, I think the market is going to be insane. 2020 was kind of crazy. As soon as COVID hit, things got a little crazy with that. And then surprisingly, 2021 was even worse. I think a lot of people kind of expected it to not die down, but just, kind of flatten out again, just because 2020 was so crazy. But it's continued in the same manner that it, was in 2021. And I think 2022 is going to be very much the same thing as well. So with that being said, just want to talk a little bit about where the market's going and share some information here. So first off, I just want to share some information here with market stats for January. January data just came out, and the number of sales was down pretty drastically from December, which is what we usually expect. Let's see, January of last year, I'm looking at sales of 2,853 homes for the entire Wasatch Front. This January was only 2,500. So sales were down 353 sales from where they were last January. So that's kind of a concern, just because we're not seeing as many homes actually out there in the market selling. So Michael, what do you think is going to happen when interest rates go up? Give us like a rundown of like where they've been, where they're going, what you expect to see.
So the Federal Reserve basically, they've indicated that we're looking at 3 to 4 rate hikes this year. For the last year and a half, they've been saying they're not going to touch rates until 2023. But now we're seeing the inflation to the extent that we are. So naturally, raising rates is one of the things you can do to sort of combat that or offset that. So they actually haven't raised rates yet, but mortgage rates are directly impacted, not really actually by the Federal Reserve itself. It's more what the 10-year Treasury is doing, and then also the bond markets. So we've seen rates go up 0.5% in the last month. So I pulled rates today before we got on, but right now, an FHA loans 3.375 is going to be the par rate with decent credit today. 3 months ago, we would have been at 3. And then 6 months ago, we were probably 2.8 all day long. That's where they're at. A conventional loan right now is going to be 3.875 par rate on decent credit. So 3.8 versus 2 months ago, we would have been a 3.1 to 3.2. So we've seen about a 0.5 point movement across the board. I don't know, dude. I think we could see mid 4s pretty reasonably, maybe even 5% towards the end of this year.
Really? You think it'll jump up that high?
I think it's possible.
And when you say that, that's for a conventional loan, right?
Yeah. So FHA, you're going to have a little lower than conventional. Yeah, I think going into the 4s is probably very realistic, probably by summer.
Okay, for conventional loans. So what can you just give us a quick breakdown on why FHA has a lower interest rate but may not be the better option?
Yeah, so FHA loans are great. They're designed for first-time buyers, so you're going to have lower interest rates. But the reason the rates are a little lower is it's backed by the federal government. So when those mortgages are purchased, they're kind of a safe debt to buy because they're backed by HUD. So if you have an FHA loan and it ends up getting foreclosed on, it basically ends with HUD is who's going to own that home. So because you have that, same thing with a VA loan. VA is guaranteed by the VA, so you're going to have a lower interest rate. And then USDA is another government-backed loan. So when you have the government backing these loans in some shape or form, the interest rates are a little bit lower. The downside to FHA is you're going to have mortgage insurance for the life of the loan. So you could be looking at a conventional loan, get on the camera, you could have a conventional loan and an FHA loan, and the FHA rate is going to be a little bit lower if you just look at apples to apples. However, the mortgage insurance on an FHA loan is going to be higher. It's going to be 0.85, where on a conventional loan, we can actually shop that out with different banks we work with, and some of them do it in-house, so we can get mortgage insurance as low as like 0.25 or 0.3. But that's why you're always going to see FHA is going to be lower, and it's just designed to get people into homes that they're a lot looser on the underwriting guidelines. They'll allow you to have a higher debt to income ratio. If you've had a foreclosure or a bankruptcy, they'll work with that, outside of 2 years, whereas like a conventional loan, it's going to be more like 7 years. But that's why you're going to see that.
So you're thinking the interest rates could potentially go up 0.5% to a full percent maybe by the end of the year, depending on where things go. What do you think that'll do to prices in the market?
I think it's going to depend on if they do 4 increases like we're talking about. That'll probably be a quarterly thing. I would imagine they probably do 0.25 or 0.25% adjustments would be my guess. That's when they raised rates in 2018. That's what they were doing. And it was 0.25% each time. And in the fall of 2018, rates hit like just about 5% for a minute, and the market stalled out because we were selling our home during that time frame. And then in the beginning of 19, then they lowered the rates back down again. But there's no inventory, so I just don't think it. Maybe it slows down the entry level, but there's such a demand. I'm not sure it's really going to affect prices. It might slow down the appreciation a little bit, but I don't think we're going to see a dip in prices. I don't even think we're going to see prices leveling out.
Yeah, that was the same information I saw, which was interesting. The 10 to 12% I think is realistic. I wouldn't be surprised to see even higher than that, just because of how much demand I'd see in the market. There's just so much demand, and the fact that home sales are going down is a little bit concerning. So like you said, in 2018, kind of in the fall, they started raising rates, and the median price along the Wasatch Front for just all housing types was basically flat from June of 2018 through March of 2019. And then once we hit April, then it started climbing again. So it's kind of interesting to look at that and see how prices reacted during that time when rates were going up. I think this is going to be a little bit of a different situation this time. I think that there's a good chance we'll see prices continue to go up. And I think interest rates, in my personal opinion, I think interest rates will slow it down, but it's not going to, instead of going like this, it's going to be more like this. So I don't think it's going to change course or anything. As long as there's no inventory, like you said, it's just going to continue like that.
I think where interest rates really hurt people is that entry level market the most, because the appreciation has gone up so much. The median price in Salt Lake County is like $500,000 now. So when you're a first time buyer and, people, it's hard for them to get, their down payment plus closing costs. And when an interest rate moves 0.5%, that really fluctuates your payment. Like a 0.5% move in rate could be $150 to $250 difference in payment. And if you're already shopping at the top of your debt to income ratio, that 0.5% rate plus an appreciating market, it really just makes the affordability on the entry level a lot harder. But also Salt Lake, this year we're pegged to be the #1 market in the country. Last year it was Boise, Idaho, and then we're actually taking the #1 spot this year, and Boise's the #2 spot. On our purchase loans, I would say 1 out of every 5 buyers is relocating to Utah for the volume we do. I was going to say, when you have a lot of California migrating this way, even though in Utah, if you're local to here, if you've been around in Utah, our prices are outrageous right now in our perspective. But you have someone that's relocating from California and they see what their money can buy them here, and they're thinking they're getting a deal. And I think that's also a reason why you're seeing, the market continuing to appreciate. We've got, from a business perspective, like we're good with taxes. It's a great quality of living. You've got all the outdoor stuff. So I don't think Utah's slowing down anytime soon.
Yeah, I agree with that. I think that, there could be something that who knows what's going to happen in the world, but I could see markets that people are leaving from, Detroit or California, these places that like a lot of people are moving out of. I could see a lot of those markets seeing a bigger hit to their real estate prices if, something does happen. But like you said, here in Utah, I think the prices are the economy is so well insulated that prices are not going to be adjusted, affected all that much. So It's kind of interesting too. I want to see if I can share my screen here. And so this is the sales data from our MLS system. So we're here in January of 2022. Like I mentioned earlier, we've had 2,500 sales. We did have 2,500 sales with a median price right here. This is the sales price. So 481,261. This is across all housing types. I didn't put any criteria in here. This is basically everything on the MLS. This is the median here. So 481 homes are still selling, at the asking price or above in many cases. And, days on market was just 12 in January. So it's a little bit higher than where it was, but nothing that's concerning. So, to see this, I think the important thing to note is that sales are down. If you look at all these numbers here, you're in the roughly 4,000 range. If we go back to just this same time last year, we had 4,000 here right as COVID hit, but in 2020, we had a couple of really good 5,000, month, $5,000 sales months. And then it dropped down here in the winter, which we usually expect to see. So that's the thing that I'm really looking at is as long as there's no inventory, I think it's kind of concerning because you're going to see that people are unable to move because they're, housing just doesn't exist. Like if you own a house, right? Like let's say you own a $500,000 house, you want to go out there and upgrade. Well, what do? I mean, because to upgrade at that point, you're spending $800,000-900,000 to make that move up. So unless your income has also gone up, you're kind of stuck, even though you've got a bunch of equity, there's not a whole lot of area, a whole lot of places to go unless you can afford that higher price range. So I think a lot of people are kind of stuck in that situation. What do you think?
Yeah, no, I agree. And I think one big thing that we're going to see just from an affordability standpoint is you're saying like, it's awesome. People who are selling right now, they're selling at the top, but then you're buying at the top as well, or you're selling high, buying high. But when you have an appreciating market, like people who are trying to, you have the equity that you have, but also if rates go up too, and you have an appreciating market go up, it's like a double whammy because you're getting hit with the market going, say it goes up even 10% this year, which is probably on the conservative side, probably more the 10 to 12 is what's projected. When the market's going up and then you also have rates going up as well, like you're getting tagged twice, right? Like both on the appreciation part. And so I think that, with a lot of people that we talk with and they're looking at, like, hey, we're considering selling, we got all this equity, we want to see what we get pre-approved for to buy a new home. And then they start looking at, they just start looking at it. And it's like I think most people are staying put. So that's why you're seeing those numbers. People decide not to list their home because they don't really have a whole lot of options unless they really want to make a move with the financial part of that. But that's why you're seeing those numbers are half of what they were last year or 2 years ago.
Kind of crazy because there's not a lot of inventory. So when something does come up for sale, there's a lot of demand for it. So we're still seeing, multiple offers in a lot of cases.
It's a lot easier to have that conversation up front before people are buying of like saying, hey, if you see the home and it's like the one you want, be prepared to have to offer over list price. And like, there's a lot of things you can do up front to be prepared to when you do find the right home, like you're ready to go on it. But also with our clients, we like to have those conversations up front. That way, when you find yourself in that situation, it doesn't seem like we're coming across as salesy as like, hey, this is what it's going to take to get there. You just kind of know that ahead of time. So if you're a buyer that's in the market right now, I think that's one thing to really, truly understand is the environment in which it is for buyers right now. It's really tough. So when you have a great agent like Cody that can walk you through that and set a fair expectation, because there's nothing worse than missing out on your dream home over 10 grand or whatever it might be, because now you're going to compare every home in the future to that one. So really just being not only financially prepared and having your pre-approval done, but also being mentally prepared and saying, hey, this is like, it's a tough environment. So we really, got to be aggressive if it's a property, it's our dream home or so one that we want. I think there's the mental piece as well as like getting pre-qualified and all of that stuff. So if you guys are thinking about shopping, I'd really give that some consideration.
If you're in the market, sooner than later is the best bet in my opinion. And I think that, prices only get worse. And eventually, let's just say worst case prices did crash, right? The median price is at like 500, 550 for a single family home or something. Prices might drop from 550 to 450, but then they're going to continue on. So it's kind of like, the stock market, if people follow that, it goes up and then it drops down, but it doesn't drop all the way back down to where it was when it started. So if you're looking back 5, 6, 7 years, I think you've got a pretty safe investment in the long run.
Another thing to look at that too is because we have that conversation a lot. People are like, "Oh, I'm just going to wait," and in 2020, people were saying, "Oh, I'm just going to wait," and now things have not slowed down. Even if prices go down, but interest rates go up, your affordability is the same. Like, yeah, you could look at the overall amount that you're purchasing, but the reality is what is the monthly payment? And if you've got a lower interest rate on a higher purchase price versus a lower purchase price and a higher interest rate, it's basically a wash.